Today, we're going to go over how to read a multifamily pitch deck, how to actually understand these passive real estate opportunities that we at Dynasty Growth Ventures are going to be bringing you. This is really important. This is really important for our investors to understand how to evaluate a pitch deck. Number one, this is your hard-earned money. And in syndication, you are handing your money to a company or a real estate group that is going to manage the property on your behalf. So you need to understand your risks to protect yourself. You need to know red flags to look out for management teams to make sure you're giving your money to competent people who can execute their business plan. You want to know about their good experiences and their bad experiences to analyze both and make a well-informed decision. Do I want to invest with these people in this market? So some of the key areas that we're going to evaluate is the executive summary, which goes over the basic story of the property. We should understand the story of the property in less than 60 seconds, which is the location, the property itself, the projected returns, and the why. That's pretty much the investment thesis. Why is this property an opportunity? Is it undervalued based on competitors? Is there so much room for rent growth based on competitors or what have you? Market analysis and economic drivers. We are investing in emerging markets, right? So we're going to add value to stimulate some rent growth, but also the market itself should stimulate rent growth from all of the economic development in the area, all the new jobs coming in. All this stimulates demand. When demand exceeds supply, the price naturally goes up. You have more people competing for the same apartment units. So price will naturally go up. That's why it's so important to invest in the market with the right growth trends. So we'll get into that too. Most importantly, the management team's credibility. We are bringing capital to a management team that is already purchasing properties. They should have experience in the market. They should be able to transparently tell us what has worked in the past, what hasn't worked in the past. If this is their fifth deal in Dallas, we want to know about the previous four. If they've gone through 2 or 3 market cycles, we want to know how they operate in a upward trending market and a downward trending market. Also, are these good people? We don't want to invest with borderline slumlords who don't really care about the tenants in the community itself. We want to build better communities. We want to add value to the property and make money in the process. Red flags to look out for in a pitch deck. An inexperienced team, unrealistic returns, or if you ask questions that they just can't answer clearly, that could be a red flag as well. Now, they might not have every answer on the actual live presentation, but they should be able to get back to you before you invest. If any of your questions just flat out go unanswered, red flag. Okay. So these are the things we're looking out for, but we want to understand the team, the management team, the market, the property itself, and the business plan and strategy first. This will give us our story, more or less. We'll understand the story of the property. Why are we investing here? What are the growth opportunities? And is it worth my time? Is this an investment that I want to make? So let's look at a real pitch deck and try to understand 1 through 4. First thing we're looking out for is the team's track record. Because if we can't trust the team, we don't really need to waste our time. We don't really need to go any further. This sponsor team has over 203 million assets under management. That means all of their properties in total, the total value of all of their properties is over 200 million. They have over 1,300 units under management. So these 2 people are not new to the game. They have assets in Colorado, Georgia, North Carolina, and Texas. This property is in North Carolina too. So that should make us feel pretty safe. So if I'm taking mental notes, if I'm listening to a live presentation, I'm thinking management team has over 1,000 units under management. Good experience in the market. We are investing in North Carolina. This team has over 1,000 units and has invested in North Carolina before. Like, I may ask about their previous deals. How are your properties performing in North Carolina? So this is what I'm thinking. But so far, they're not new to the game, at the very least. We know they're not new to the game. So next, we want to get into the market. So I'm going to skip ahead a little to understand the market better. We're investing in Hope Mills, North Carolina. What are they telling us? Right now, I'm just looking for stuff about the market. They're telling me it's a Class B location, which is decent. That's where we want to be for location, and it's a Class B asset as well. We'll get into what all of that means. Excellent market fundamentals. Fayetteville MSA has strong market fundamentals and recession-resistant employment base. I'll just highlight a couple things. These are things we want to pay attention to. Steady population growth. Rent growth is very high. Unemployment growth. So all these are factors we can compare to the United States average. These are some of the economic factors that let us know if we're investing in an emerging market. This market is growing very fast. I will put some stats on this video to show the USA average and then how this market is growing. But so far, this seems to have some of the qualities of an emerging market. Positioned within a high demand submarket with limited new supply. That's good. Remember, we want as many people as possible competing for our apartments. That is what drives the price up. We want demand to exceed supply. So when it says limited new supply, that is a good thing for us. Set to receive over $85 million in infrastructure and support investments. So people are investing in this area. That's just another indicator of economic development. So there's more, but quick note. Has healthy conditions for an emerging market. Population growth, historic rent growth, and job growth. We saw healthy metrics for all of those things. Regional overview of our MSA, which is our metropolitan statistic area. This is our market for pretty much. 400,000 residents in our market, MSA at least. Multiple historic sites, 7 museums, galleries, restaurants, bars. We want a vibrant downtown, right? Think about if you want to live there. Would you want to live anywhere boring with nothing to do? Do you think a lot of people would move there? So some of this is common sense. Fayetteville's heavy military presence provides most of the strong economic stability with Fort Bragg. Total economic impact of 8.1 billion. So this is a heavy military area. That seems to be what's keeping this market stable. But if it's only dependent on this military base, that could be a yellow or red flag too. So we could have some questions. Because what if something happens to the military base? What's the likelihood of that? So these are questions that we could ask to our management team during the live presentation. So I'm going to put 2 heavily dependent on military base. Question, not a statement. And depending on how they answer that, will let us know how we move forward. 265,000 military personnel and employees, retirees, family members all around this area. So this is a military area. Besides the military base, they're saying there's also decent education, healthcare, retail trade, and public administration industries. We want stable industries. If COVID taught us anything, it's that a major event like that can wipe out an entire industry. Some places were closed forever. Why do we want a strong job market and diverse job market? People need to pay their bills. If their job disappears one day, what are they going to do? Okay, so we do have a regional airport nearby, not an international airport. Why else would we want to invest in this area? Here are some metrics that they found, and they have also listed the sources. If we want to, we can double check these sources. But it's saying it's the number one cleanest metropolitan area, number one job market in the country for recent college graduates, fastest growing city in North Carolina, fastest growing city in America, third fastest growing city in America, third best job market in the nation. But we want to know when these articles came out. So we can't just drink the Kool-Aid all the time. What else do we have going on? Cape Fear Valley Medical Center, hospitals. This is what we want to see. We want to see hospitals. There's a VA hospital. We want to see education. Fayetteville State University, Amazon distribution, another Methodist university, decent. Fort Bragg, 12 minutes from our property, with over 63,000 military personnel. We also see some economic development. It's good to have growth in the pipeline. We want to see development in the pipeline. That's really how we can understand an opportunity before the competition. If everything's already beautiful and built, everybody's going to want to invest there. But if we can get in at times where they're still developing some of the parkways, bridges, highways, and new companies coming in, that would put us ahead of the curve. Goodyear Tire and Rubber Plant, an aerospace project. So we're starting to see some diversity, right? Not just Fort Bragg. So overall, the market seems pretty healthy with some economic development in the pipeline. We basically want to know, how does this economic development impact population growth and job growth and new households being formed? These are the factors that will drive demand for our property. These are the factors that drive rent growth up and drive people to a location, right? So again, this is the mind of an investor, an LP investor that doesn't know anything about anything, right? I'm coming in with minimal knowledge as an LP investor about North Carolina in this area. If you're on our investor list, you will be receiving updates about all of the markets that we're interested in, South Carolina, Tennessee, and North Carolina, etc. But I'm acting as an investor that knows absolutely nothing. And this pitch deck is my introduction. And you need to sell me on this place, this team, and this property. So we're done with the first two. Next is the property itself. But you can kind of see we're starting to round out a story here, which is good. Here it is. I almost skipped this, but we see most of the employees, almost 90% of the employees are coming from Fort Bragg. Then we have some in the medical system, Walmart, Goodyear Tire Rubber Plant. So it's not perfect. It's not perfect. It's very heavily weighted towards Fort Bragg. So as an investor, I could be uncomfortable with that. It could be a yellow flag or a red flag, depending on what they tell me about Fort Bragg and how stable that facility is. Because again, if something were to affect the government or military industry here, there is a high chance that some of our tenants will be working here. I'd pretty much say there's a 90% chance that some of our tenants will be working at Fort Bragg at this property. So we need to understand all the risks related to the government and military base over the next 5 years and how that could impact our tenants, since we are so heavily weighted in one area. So again, this is red flag, I would say. Not a deal breaker, but just something to ask about and understand. Okay, this is still related to the market and kind of the property, but these are all of the other, this is our competition, our comparables, all of the other apartment complexes in the area. We are right here, Woodland Ridge, and we want to, well, we'll get into the rent comparables later, but we do want to at least understand the occupancy rate at these other places. We would like to see occupancy rates higher rather than lower. Low occupancy rates means vacant units, which could be a red flag for tenant demand. If everybody has above 95% occupancy, that's a really good sign. That means a lot of units don't come free often. So when one does, it's a rare occasion and there's a lot of people bidding. If there were a bunch of low occupancies below 80%, then it's like units are just sitting and we don't know for how long. But I'm seeing a mix of pretty good occupancy numbers, a good mix of occupancy numbers above 90%. So I'll say that's a good sign. Yes, as an investor, you should be starting to understand the story. The management team has decent experience, over 1,000 units under management, over $200 million in assets. That's great experience. These people are not new to syndication. They're not new to operating apartment complexes. So again, we would just want to know how the current properties are performing in North Carolina, see what deals went good, what went bad, how many market cycles they've been through, things like that. But so far, no red flags there. The market has healthy conditions for an emerging market with really good population growth and rent growth. But are we too heavily dependent on the military base? There were 63,000 jobs at Fort Bragg. Now let's get into the property itself. So 60-unit property, 34 units built around 1985, 26 units built in 2004. The year that the property was built lets us know the class. Obviously, the older the property could mean the more renovations required. Occupancy at 93%, which is pretty healthy with just enough room for growth. Market rent versus our rent. This is one of the biggest factors for our investment. And again, these properties run like a business. They're based off cash flow. Cash flow is driven by how much rent we're collecting from our tenants. So let's say we got all of our units to market rent by increasing each unit by $100. 60 units, we're raising rent by $100. So we can add $6,000 a month in income growth. So for the year, it's about $72,000 in income growth. And if we divide that by the cap rate, let's just go with 6% as a standard. We can add over $1 million in property value by just getting our rent to market price, right? Income divided by cap rate gets us our property price. So we can get into that later, but just know that there is $1 million of unseen value just by getting the in-place rent to the market price, right? So is there opportunity at this property? Yes, there's opportunity to raise the value by at least $1 million. Okay, 52 of the 60 units have already been upgraded. That means our renovation costs could be a little lower, but there's still room to renovate 8 units and get a higher rent out of that. Because obviously, we're not going to renovate for nothing. We're renovating to attract a higher market price, make this unit more attractive to the potential tenants. Updated HVAC and new roof. Roofs can be very expensive, so good to know that the roof has been updated. Let's see. Now we're just looking for stuff about the property itself. Average in-place rent, average market rent. So there's a decent premium available to add, like I said, potentially close to $1 million in value if we could get all our units to market rent. Aside from raising rents, there are other ways to add value, like different amenities for cable, internet, trash, pest control, different amenities that you can offer tenants that they will pay for, right? So there are fee programs for cable, internet, tech, trash, pest control. My building, I know we have other vending machines, pet services, dog walking services. These are all other drivers of income. Reserved parking or covered parking is another thing that we can charge for. These are fees that the tenants will happily take advantage of and add to our cash flow. So if we're able to add or improve some of these amenities, then when we go to sell, we're selling at a higher cash flow than we bought it for, which again would increase returns for you as an investor. When I say buy low, sell high, we're buying at the current cash flow. We want to sell at a higher cash flow because that next buyer will pay more for it. Or what notes do we have so far? Opportunity for rent growth. How could I say this? Opportunity for rent growth. There's about $132 premium. Premium just means potential from what we're currently charging to what the market says we can charge. This is a really good sign. So knowing that that we have a new roof and updated HVAC already, good signs. I believe they said 52 units already renovated. So we still have an opportunity to renovate 8 and get a higher market rent for those 8. And I'll include that 60 units in total. So overall, this is a Class B property, which is good. We like around Class C or Class B because there's always room for growth. They're not bad places to live. They just haven't been updated in a while. So we're going to seek these opportunities to add value, get rent up to market, and look to sell when our business plan is completed, when our property value is higher. But it does show the property. Very nice. North Carolina, a lot of outdoor space. Very nice. These are what some of the classic units look like. These are the renovated units. So you can see they went stainless steel, white cabinets, marble countertops. So you can see the potential for rent growth. How much can we charge for a classic unit versus how much we could charge for a renovated unit? This is the opportunity that we're looking for. And this pitch deck is doing a good job of explaining. Of course, they would explain these things during the live presentation, but just from looking at the pitch deck, clear renovation strategy. Okay, so back to this. Understanding if Woodland Ridge is a good investment compared to the surrounding areas. First of all, some of them are pretty far. We are closer to 95, which could be a plus. Also, our rents compared to these other folks are towards the bottom, but sometimes it's not always apples to apples. We want to make sure we're looking at the year built and the size, because of course you could charge more for a newer apartment and a bigger apartment. Yes, some of our units are built in 2004, some are built in 1985. So keeping all that in mind, we're still pretty low compared to the competition here. Good sign. And a lot of potential for growth. That's the main thing here, potential for growth. Now they're actually showing us what these other units look like. That's really important as well. They're just giving us numbers here, but it's easier to understand why they might be charging these rent prices if we can see what they actually look like. So let's look out for Hidden Lake and Timberwoods since they're charging the most. Hidden Lake, Timberwoods, and here's our property at Woodland Ridge. They don't look that different, which is a good sign, but they do have more of a unit mix. These are all two-bedroom units. We like to see a unit mix to attract different tenants. You can get more for a three-bedroom, two-bath, of course, than just a straight two-bedroom, one-bath. But given that the occupancy is where it is, these are still in demand. But if these were all studio apartments or something, it might not fit the demand of the market. If our market is mostly families, nobody's going to want a studio. So that's why the unit type is very important. Balconies, balconies, balconies. So yeah, pretty comparable complexes here. I, some of these places have fitness centers and we don't. So we can ask about that. What other amenities are we looking to add to compete with the competition and justify rent growth? Because we're not raising rents for no reason. If we were to do that, tenants would move. We want to add value, create a community, and then align with the market from there. We don't want our tenants to move, right? So how are we competing with some of these other places? That's the main thing to understand. 24-hour maintenance. Some places have storage space. This is all also can be opportunity for us to steal the blueprint here because we don't have storage space. We don't have 24-hour maintenance, but we probably wouldn't for 60 units compared to some of these huge facilities. It just doesn't make sense. But we can understand what the management team's plans are. Low rent compared to competition. Verified. Looking at these comparables here and the pictures and the amenities that they offer, we can understand that there's likely potential to raise rents to market price with the right renovations and value add items. This is also important here. We are purchasing a property. We're really purchasing a property, right? So we want to understand if we're buying this at a good price compared to other locations. Now, looking at this here, we're buying our property, Woodland Ridge, for $130,000 per unit. That seems to be low compared to 7 comparables. Built at different times, but we can see that we're not buying this property at a terrible price. It looks at least fair priced compared to the market. But I do see a typo. I see 100 units here. We do not have 100 units. We have 60 units. So depending on how you feel about typos, that can be a red flag. Let me check their math. Divided by 60. 60, yeah, not 100. So that's one typo. Red flag, yellow flag, up to you. Purchasing at a low per unit cost compared to the market. And what I mean by that, we are purchasing this property at $130,000 per unit compared to some of these other sales that were at a much higher price. Take note the year that the property was built as well. Some of these newer properties were selling for higher, of course, but also some of these older properties were selling for higher as well per unit. So nothing horrible there. So far, these are all factors that say this is a decently priced investment with room for cash flow growth and a clear path to cash flow growth. When it comes to the team, we're looking for credibility. When it comes to the market, we're looking for room. We're looking for an emerging market with economic development. When it comes to the property, we're looking for fair price with room for cash flow growth, but not just room, clear price, clear path, excuse me. Fair price with clear path for cash flow growth. Based on these three things, we're starting to understand the story of the property. We need to understand the team that has over 1,000 units under management and $200 million in assets. We feel pretty good about that. And they have previously invested in Georgia, Colorado, Texas, and North Carolina. We feel good about that. I'll say they passed that test. We feel good about the market. We feel decently about the market because it is heavily dependent on the military base. That is the only yellow to red flag that we need to understand more. There does seem to be some economic development in the area, in the pipeline, down the line, which is good for our property. But we want to know what other major projects are going on that can stimulate demand for the area. Now, the property itself, 60 units, all 2 bedrooms, which could be a red or yellow flag. We want to make sure it's an attractive unit mix for the area. But given the occupancy, I'll say it is. I believe our occupancy was 92% or 94%. There's opportunity for rent growth compared to the competition in the area. We saw what our other apartments look like in the area, and there does seem to be a likely scenario where we can add value, do some light renovations, and raise rents to market price. We saw what a renovated unit looks like compared to a classic unit. There is a big difference. There is a clear renovation strategy. And lastly, we're purchasing at a low per unit cost compared to the market. These are all great things and should at least keep us occupied to listen further about this investment opportunity compared to the business strategy and the projected returns, which we'll get into next time. It's really important for you to understand these pitch decks, understand how to ask questions before we get on to a live presentation. That is the point of this. That is the point of this exercise. So if you at least understand how to evaluate a team's credibility, a market, and a property itself, then that's good. Next, we'll get into returns and how to understand their business strategy as a whole, which would include the holding period and a little bit more. All right. Thank you, and I'll see you on the next one.